Before we start this week's podcast, I'd like to say a quick thank you to our podcast sponsor, PensionBee. Now, PensionBee is one of the UK's leading online pension providers that helps consumers combine, contribute and withdraw from their pensions, all through the PensionBee web and mobile app. Now, you can sign up with the names of your old employers or providers in just 5 minutes, and PensionBee will help you find, transfer and combine your old forgotten about pension pots into a low-cost online pension plan. Now, these are managed by the likes of BlackRock, State Street Global Advisors, Legal & General or HSBC. Now, they have over 250,000 customers that have already signed up to combine their pensions with PensionBee, combining close to £1 billion into their plans. You can also find out more information about PensionBee at pensionbee.com, and as always with investments, your capital is at risk.
Hello and welcome to episode 260 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leakes. Damien, how you doing?
I'm good. It's been an exciting week. I'd say an eventful week if you are looking at anything to do with money, because the stock market has imploded. Yeah. So if you've been following midweek markets, you will have seen me talk about it on that show, and it's eventful and it's interesting to watch, and it's taken up a lot of our time, hasn't it, really? Almost like on the side you're watching, it's out the corner of your eye it happen.
It's interesting watching you when these things happen, because most people involved in finance and investments, they're tearing their hair out and they're running from room to room, sort of almost, heading for the exits. But you have this weird sort of, not a smile, but a sort of, I don't know, a very calm, you take it all in, and I don't know how to explain.
There's not much I can do about it. Look, I'll be honest with you, on this sell-off that we've had, ahead of it, if you're an 80/20 investor member, you will know that I reduced my equity exposure slightly, and the equity exposure I have is more defensively positioned, so it favours sectors that are defensive, but sectors that aren't as exposed to the economy and the global economy, so not the cyclical sectors. So of course, in this environment where all boats are sinking, if you look at the performance of my portfolio relative to everything else out there in terms of the multi-asset funds that professionally run, it's doing well. So some of those are completely imploding, losing 8% in a week, and mine's still in profit year to date. So that can change. The market continues to fall, but the point is, if you put a ranking going on, then my fund or portfolio, if it was a fund, would be in the top 10 versus funds that have the similar equity mix. So I'm obviously pleased about that, because in a market that's continuing to rise, that can hold you back if your portfolio has got a sensible equity exposure. But of course, the market was stretched. Nobody knows when the markets are going to turn, what's going to cause them. But it's just funny, because now we're looking back. We published a video, didn't we, on midweek markets with the question, is this, or are we near the top?
Are we near the stock market top, I think it was.
Yeah, and within about 2 hours of that, the market topped and we've collapsed more than, depending which indices you look at, but it's more than 10%. And the selling's been relentless, but it's been interesting. So going back to your point, Andy, the reason I am sanguine about the whole situation is because I've been positioned in a way that has been based on what 80/20 investor and the algorithm and everything like that and the research, based on the idea that what's been working in the background, the global economy has been slowing, earnings have been slowing. So there were cracks appearing despite what you would hear on Bloomberg and things like that, saying that the only way is up. Now, central banks will come wading in soon. I have no doubt about that, and push the market probably higher if they can manage to with the liquidity measures. But the point is, by sticking to a process, I'd get rid of the stress of it. Don't get me wrong. Running 80/20 investor comes with its own pressures and stress, but by sticking with a process, it helps me to try and not get too carried away. And for me, just doing nothing. And sometimes some of the best things to do in market conditions like this is to do nothing. You start chasing your tail. And if you follow me on Twitter, you'll see I've been using quite a number of different GIFs to illustrate that point with a little bit of humour.
It's a busy time. It's an exciting time in investment world. We've actually seen that in the group as well. In our Facebook community group, lots of people are posting. I'm seeing sort of questions in there about, is now a good time for this or that? Now, there isn't any perfect answer, but it's a good time for you, the listener, to get involved in that and sort of post your questions if you have them, because Damien dips in, I dip in, and you can get answers from the rest of the people in our group at the same time.
And as you say that, there's some good ones about people eyeing an opportunity, because if markets have fallen, then things are cheaper. And so it's a bit like if you go to the shop and there's a product and it's on a sale, you can get it cheaper. And if you're a long-term investor, some of these pullbacks you shouldn't be too obsessed about. And in fact, that is one of the pieces today. I'm not going to dwell on the stock market sell-off because it's a natural phenomenon of what you expect in markets. And people think stock markets can only go up, and that just isn't the case. A pullback of 10% or more is a regular thing. It happens periodically. There's been analysis, which I'll talk about later on, and I will refer you back to a previous podcast. So it's just to give you context and telling people, look, panicking and being emotional in times like this almost inevitably leads you to the wrong decision. So that's going to be one part, and that's based around a question I got from a journalist. I won't name the newspaper because it hasn't gone out yet, I don't think. So I often get questions from journalists, and I give them my view on whether you should. This one is about whether you should use your ISA allowance this year based on what's happening with the coronavirus, and if so, how. And I'm going to give you the answer to what I said to that person, but I won't name the newspaper because I don't think it's been published yet, and that wouldn't be a very good thing to do. Coronavirus is obviously topical. We try not to date this podcast, and we want to try and keep it evergreen, but the travel rights is a big issue. So I like to use things in my own life as an example. My wife and I were talking about should we try and go away or anything at some point, because I clearly don't take enough holiday, and the coronavirus is an issue, especially if you're trying to travel. What are your rights? So I'm going to do a piece on that. And the third piece I'm going to do is about buy-to-let. Now, there'll be people almost falling off their chairs. They'll be excited to hear I'm talking about buy-to-let because people think I don't like buy-to-let. That's not true. What I don't like is the general consensus or view about buy-to-let. And the piece today that I'm going to do is around buy-to-let because I went to an event, a buy-to-let event for landlords. I was invited and I went, and it's all about that. So I'm going to talk you through it. There's some absolutely fascinating insights that I gained from going to that. I'm going to share those with you today.
Great. So what are we going to start with?
Let's do the coronavirus travel rights. So one of the big issues you've got now, there are people who have holidays booked or they have flights booked, they have travel arrangements, and they may be worried about what is going to be the impact of the coronavirus on their holiday. Will they be able to get their money back? Can they change their mind? So the short answer to that is it very much depends on what the Foreign and Commonwealth Office says about the place you're going on holiday to or you want to travel to. So to give you an example, in China, the Hubei province, I'm probably saying that wrong, but where the epicenter of the coronavirus is, where it started, that is being classed as a no-go zone for travel. So they've advised people not to go there. Now, there are different degrees. I mean, you wouldn't want to go there probably anyway, but they've just made it.
They've made that clear.
They've made that clear. But the reason it's important that they make these distinctions because it has an impact for people when they obviously advising them for their own benefit and the benefit of other people in the UK when they come back, but also for their own rights because of what happens with travel insurance, for example, and refunds. So they have another degree, another categorization, which is they advise against all but essential travel. Now, they've applied that to China, but that particular province I mentioned, they've actually said it's a no-go area. And what you've seen is in other areas of the world, as the coronavirus is spreading and you're getting pockets of the disease and it's spreading, in Italy, there have been 11 towns. As I make this will change. It's moving so fast, this story, by the time you probably listen to this. There were 11 towns in quarantine in northern Italy. And my wife and I had been just planning and saying, shall we go to northern Italy? So I think we won't be doing that trip now. And it's more actually, personally, the big issue is that when you get there, you don't want to be stuck in quarantine or you don't want to be having your holiday sort of curtailed in some way or limited by what's going on because of the rights that you have aren't always that great. So in that example, you're advised against all travel to the quarantine towns, all but essential travel. But the region itself, which those towns are in, which is in northern Italy, there is no official word on that. They're actually not advising against any kind of travel. Now, this has a big impact on your rights as a consumer. So if you go to a no-go area, then you are entitled to a refund from your airline or your travel insurance company. They should give you your money back. They should refund it. Now, the Telegraph had quite a good piece on this, and they looked at each scenario. So if the FCO, so that's the Foreign and Commonwealth Office, said designate somewhere a do not travel area, then most insurers should cover this, so they should be able to pay out on this. Now, they've gone through, most said it's fine, but you need to go through the travel operator first. So if you've booked flights, you need to actually make a claim against the airline or speak to the airline first. There can be some limits on policies, whether they actually will pay out on the inability to go to an area that is designated as do not travel. Of course, with all these things, it would be nice to be a complete one answer fits all, but there are some insurers, they claim that Virgin Money said it will consider each claim on its own merits. Now, with airlines on their own, then if you've just booked a flight, they should provide you with a refund for flights booked to the destination that is now designated as a no-go zone. So the no-go label for a consumer, yes, you're not going to be able to go on holiday, but the positive is you're likely to get your money back.
A full refund.
A full refund, but not compensation of any kind. There isn't sort of compensating you because you weren't able to go. Now, the grey area is where you have a destination where you've been advised against travelling to the area. Now, what you need to do with them is you have to check with the airlines. If you booked flights, you need to check with the airline to see what their view is. Now, for example, some of them are allowing you to just rebook on other flights. Some are allowing refunds. Now, the table I mentioned in the Telegraph gives a bit more detail, but I was looking at it and it almost already looks like it could be a bit out of date with some of the airlines changing, I've read in other places, slightly contradictory information. So what you need to do is check with your own airline. You're not guaranteed to get a refund of any kind because it's at the airline's discretion. So it's a grey area. Insurers vary. So whether you'll be able to make a claim for not going to a destination because it's obviously got the restrictions on it, all but essential travel, then again, it's very much depends on the insurer. It'd be lovely if they actually came out and said they all would, but they won't. And some of them are, again, case-by-case basis, and some of them are actually saying no unless you've got a particular wording in their policy or bought an add-on. The good news is, if you've bought a package holiday and an area is designated all but essential travel, then you are entitled to a full refund. Or you can have an alternative destination, a safe destination, but you can get the refund. And it doesn't have to be a no-go area. It can be all but essential travel. So that's a big tick in the box.
And is that because of the atoll rule?
So yes, that's one of the benefits of package holidays. So it begs the question, if you are thinking of going away later in the year, then a package holiday may offer you more protection than it currently stands with just if you book a flight, for example, and then relying on the goodwill of the airline or your insurer if they will pay out. Now, the other thing to do is you need to make sure that you book insurance as soon as you book any trip, because the way it will work, if an area becomes designated as a no travel or all but essential travel, then if it happens and you haven't got insurance, if you then take out insurance subsequent to that, the insurer will definitely not pay out because you knew about it before.
You're insuring after the event, which isn't allowed.
No, and it's a bit like if you know there's going to be strikes on an airline and you try and book insurance just to protect yourself, but you did it after the strike was announced, you won't be covered. So it's the same thing. So if you're going to be booking any travel or holidays, then make sure you book your insurance. Check the T's and C's of the insurance. And also you can ask the insurer what they would do in the event that there were designations, as I've mentioned, from the FCO. So ask the question. The bottom line is, if it's a no travel area, you're okay. You're going to get your money back. If it is a all but essential travel designation that's put on it by the FCO, then it very much is a grey area. But if you've got a package holiday, then you should be pretty safe. But one last point I'll make out, if it's just a case that you're sitting there thinking, oh, I don't know, I want to go on holiday to the destination now because the number of coronavirus cases has been rising, for example, then you've got pretty much no hope of getting anything from anybody. The insurance company and the airline, if it was a separate booking as an airline, they won't protect you against the fact you do not want to travel. So you're not going to get anything back. The only thing you could do is speak to the entity concerned and ask them if they would be able to change or do anything like that. But they're not under no obligation. So your decision not to, that's just like you decide not to go on holiday and then trying to make a claim that you couldn't be bothered to go. So that is going to be an issue for people. If they're likely to be concerned about coronavirus in the future and are the sort of person who wouldn't go on holiday because of it, then they should probably think twice about booking a holiday, which I don't really like to say because it's one of the things that obviously hampers economies and it's a vicious circle everyone can get into. But this this is the impact that the coronavirus or a scare like this can have. It's more about the scare, the changes to people's behaviour, the quarantine, than the virus itself, because it will then start to disrupt supply chains. You won't be able to buy certain products that you normally like, for example, iPhones and things like that. You'll probably find going forward some of the products that you buy and like and services will start to be disrupted, and that's where the issues are and why we can end up with a recession that we perhaps weren't going to be in, although there were signs that we could have been heading that way anyway coming into 2020. But the coronavirus is almost akin to a black swan event. Nobody was expecting it, and suddenly here we are.
Yeah, and it means that you and I right now are looking at the grey weather outside, longing for a holiday and not able to commit to anything.
Or go to the UK, I suppose. That's the answer. But yeah, that's exactly it, Andy.
Good stuff. Before we move on, actually, I should mention our mugshot wall of fame. It's looking great up there. We've got approximately, I don't know, between 30 and 40 up there on the wall, but we want more because we know there's about 50 of you out there who've received mugs for mug-worthy things, and you haven't yet sent us your mugshot. So please get in touch with us if you've got a mug. Take a picture with you, with a lovely background if you like, in your house, outside in your garden, with your pets, anything you like. Be as creative as you like. But we'd like to see those mugshots because we want to put you on our wall of fame. You can get in touch with Lauren. It's lauren@moneytothemasses.com, and we'll even give you a shout out on the podcast. There we go. Right, moving on to the next thing. We're going to be talking about buy-to-let. You mentioned at the start of the podcast, Damien, that people think you're down on it. You're not. It's just the way that people bang on about it. So you're going to go through a few things that you learned at this event.
Yeah. So Habito is an online mortgage broker. So if you want to know more about Habito, then you can go to their website, or you can read our review of them, actually, because we've done a full review of Habito. They're an online mortgage broker. So it's like the new way to do mortgages, and their service is very good. And I mean,
I even use them myself. So
yeah. So there you go. Andy's even used them. So what happened? I was invited to an event. It's a meetup. Habito have started to try and do regular events where they get a speaker, and I think it's often Kate Faulkner. So that was who did it. Kate Faulkner, if you find her on Twitter, for example, it's at Kate, Kate Faulkner, which is Faulkner. And she's a property expert. She advises government. She talks about meeting housing ministers, builders. I think she's a buy-to-let investor herself. And she is incredibly knowledgeable on the buy-to-let arena and that whole area. And I mean, it was impressive watching her. I really enjoyed it, even though buy-to-let isn't my thing.
It's one of those few examples when the word expert is banded around and you think, yep, they've nailed it there.
Yeah, but she's interesting. She's got a style that isn't dry. She's a human being. And what Habito have done is created a kind of a movement where they've got a Facebook group. It's only very small. You can find it. It doesn't seem to be a lot of activity in it, but you can join it. And they do these periodically, talking about things to do with buy-to-let. They record some of it and put videos. And what I've got is the presentation slides. I've got a copy of them. I'm going to put them in the community group on Facebook. They've said I can do. And I'm going to kind of tour through it. I'm going to go through it quite quickly. But more importantly, what I'm going to do is tell you the key takeaways that I personally took from the event, the overarching lessons. And I think it's be quite insightful for people out there who think they're going to be buy-to-let landlords, and it's pretty easy, because the biggest lesson I learned is that it's not. And now, just some sort of general trends that they mentioned in there, that buy-to-let landlords, there was a report that came out recently that showed that the number of people with buy-to-lets had individual landlords that had fallen slightly, but the number of what they call portfolio landlords, so people with more properties, or a number of properties, had increased. So with the changes that have occurred in taxation in recent years, there was a change on the tax relief for buy-to-let landlords regarding their interest they pay on their mortgages. There was a change in the rules which made it less attractive for buy-to-let landlords. And so as a result, there was a bit of an exodus from some of the people who were not necessarily these portfolio landlords. But what it means is they're picking up more and more properties. Now, one of the key things that they highlighted numerically, which is why I wanted to get a copy of the slides, because I'm not going to do it on the podcast. It doesn't really work. But it was to highlight the differential for somebody who's a basic rate taxpayer, who's a buy-to-let landlord, under the rules as they are now versus what they were previously before they started to phase out the tax relief on mortgage interest. Now, the sort of high level is that a basic rate taxpayer, on the example that they gave somebody who's paying £950 a month of rental income with mortgage interest payments of £600 a month. They worked out that a basic rate taxpayer under the new regime versus the old one would largely be the same. But what happens for a higher rate taxpayer, so that's somebody who is taxed at 40%, is that their tax bill will rise now from £1,680 pre-April 2017 to £3,120 as of April 2020. Now, I say will rise. It has been rising all the time because it's been slowly phased in. But after April 2020, there's no tax relief on mortgage expenses from rental income. It's a sort of tax credit system. It just shows you that for higher rate taxpayers, this can actually be really punitive. And I've heard of people who are buy-to-let landlords now who they may be working, they have another job, and they actually now get to the point where they're not making much money on their buy-to-let, now having to consider selling it. And so this is why you've seen some people sell. Now, the one thing I want to just throw out there, one of the solutions to this is to become a limited company. So what happens is you create a limited company that owns your property. So you'll have a buy-to-let company. And that means that you can then save tax because it's a limited company. It's taxed as such. It's more complicated. But what it does do is massively reduce that tax bill. Because don't forget, a limited companies, the way they're taxed, it's obviously 20% on profits. So it's a little bit more complicated. It's going to be more expensive because the rates for company buy-to-lets are more expensive. There's obviously going to be extra stamp duty because if you've got existing property and it's got to be moved across to the limited company, there's issues there, particularly around stamp duty. The tax is more complicated, etc. There's obviously dividends and things like that. What it means, you're going to need professional help. So what I'm just highlighting there is that for a person who is a buy-to-let landlord or wants to be, and they may be a higher rate taxpayer, then they will be better advised to do it through a company structure. So have to create a new one. You can't have an existing limited company that does something else and then go and try and buy property with it. It's got to be a separate entity. So, I mean, Habito, the experts and all that kind of thing. But what was interesting to me beyond that is that Kate went through and started talking about the idea of buying property and building a portfolio. And so what tends to happen, we're very London focused. I mean, not everybody who listens to this podcast, obviously, but all of us who live in the southeast, we're very London focused, and we sit there and think that if you buy a buy-to-let in London, then it's almost a simple copy and paste job if you go and buy somewhere else in the country that you might be able to buy and afford a property at a lower cost. And she said that's gone. That is no longer the case. There are much more nuances now than before. It isn't just the case just because London's doing well, what happens in London, you can just go and do the same thing you were doing there and then go and repeat it somewhere else. What it emphasised to me is that buy-to-let investment is not simple. You have to do your homework. The trouble we have in this country is that we think, because we understand property, we know what a house is, we know if you charge rent and those sorts of things. It's a very simple idea. Therefore, people think I can do it well because it's simple. When they look at things like investing in funds or they invest in equities, bonds, all these things, it feels more complicated than it really is or needs to be. So they will always tend to feel that they will do badly at it or worse than if they would do buy-to-let. They think because they bought a house, they understand buy-to-let. And what she highlighted are some wonderful slides in the presentation showing how the annual property price has varied across the country. She did it by regions, and it varied from 1% to 5% from 2005. And one of the trends is that since, say, 2000, it was fairly standard, the price increases across different regions. And she did it for like Northwest, Southwest, East Midlands, West Midlands, London, South East, East, in those regions. It was fairly standard across all of them if you look at it since 2000. But as you come to closer and closer to today, so if you look at the trend, say, since 2005, that's where the variation is now occurring. So it isn't now standard. It's that thing I was saying before, you can't copy and paste from London to other regions or from region to region. And the other thing she highlighted is rental growths vary massively. And again, it's 0.5% a year to 2.25% a year. And actually the strongest annual growth rate was in the southwest. It wasn't, and I mean, London, it wasn't even, it's probably about middle of the table that she's done at about, looking at that, it's just under 1.25%. The point is that's below inflation. And there's a lot of areas that are below inflation. In fact, the Southwest, East Midlands and the Northwest are about the only areas that have had an annual growth rate in rental income that has beaten inflation. And then she highlighted another key point. She picked Aberdeen, and she said that house prices aren't universally going up. There is a myth that people do think house prices only go up, and she pulls out a fantastic chart which goes back to 2008, which is over 12 years, and she showed that property prices have fallen by 6.4% since 2007 actually, and they're 26% lower than 2014. And it's showing you there's nuances within the property market in different areas. So if you just thought, I'm going to go and buy a property up in Scotland and it will go up just because the prices have gone up in another area of the country, then you could be sadly mistaken. And rents have fallen by 30% in the last 5 years there. So again, this is just highlighting to people, you need to do your research, because rents don't just go up. Like I say, it fell 30% in Aberdeen. You can see the slide.
It's a huge drop, isn't it, in 5 years? Wow.
And so people go, well, how does that happen? And as Kate was pointing out brilliantly, the biggest constraint is the money that people have. If you don't have the wages, they won't pay the rent. And so rents will be constrained by that. And you can have the impact of the local economy, what's going on in the local economy, whether there's a particular, say, sector that does particularly well. You could be maybe in Scotland to do with oil or something like that. Whatever the nuance is for a particular area in jobs, if something happens, it could be a huge factory that might employ lots of people. If it closes down, it increases unemployment, then that will start to have an impact on earnings and property prices. And this was the whole point of her presentation and talk, was how the local economy impacts the return on your buy-to-let. It's not just a case of you going to buy a house and thinking, yeah, this will work. Supply and demand is influenced massively by things like wages, unemployment, population growth. And she's gone into so much detail looking at things like the number of people at pensionable age, how that's going to change, because it can change the dynamic of the properties that people want. For example, if you live in a town that has a particularly elderly population, then it's no good you buying properties. I forget the place she gave. There's no good you buying properties at the top of the hill because people just won't want them because they won't have mobility scooters.
Skipton, I think.
Skipton, that was it. So Skipton was a perfect example. I've never been there, apparently. It's the way she described it. But it's equally, if people have children, what sort of properties are they going to want? And she then did a whole section of comparing Cambridge and Nottingham, which is worth looking at. And the level of detail she goes into, it takes her 2 weeks apparently to look at all these numbers and do research in areas she doesn't know. And so she will look at things like population growth, projected population growth, wages, unemployment, the makeup of that population, whether it's students, for example, what's driving demand, infrastructure projects. So she will look at things like high-speed rail networks, whether there's plans to build large numbers of new homes, because if there are, then it's going to be an oversupply or an increased supply of homes in that area that will keep a lid on your property price. And so you might think, well, how do you find that out? And the answer is that every area of the country, so every local authority has to produce a local plan about containing the plans for the future, all these things. They even, on these plans, show you areas where if somebody was to apply for planning permission to build houses, where they're likely to approve it. So all this information is out there, but you have to sit down and you have to go through it. Like I say, it shows you how she's done it and looks at historical rental income. So she looks at how rental income over time has gone up and down, whether it's peaked, whether property prices have peaked. And she looks at the future, like I say, projects out what's the likelihood of growth, what's the likelihood of infrastructure projects, what's going on at the local university, what type of housing do you want? And a good example that she gave was you will see in an area there'll be maybe a load of new build flats that were put up and people rush in to buy them because they think, this was in Cambridge actually, that people would go and want them and they'll be able to sell them on and rent them out, etc. But the problem is they didn't understand the local area, the people who bought them, that you could buy a terraced house down the road for probably half the price. And yes, that people came in and wanted to live in those flats, etc. But while people may move into those flats or they may buy those flats, the question then becomes, what happens to people when they want to move on? People eventually, when we live in flats, want to go and buy, perhaps they're having families, they want to buy something with a garden or more space.
So those very terrace houses that you're talking about that were cheaper, they might actually want to move to those.
Yeah, or other people do. And what happens, the price on those houses are going up, but the flats aren't necessarily doing that because the demand then suddenly becomes, because you get an influx of younger people who don't have children who might like those flats. Eventually they want to buy the next house. And so what happens is you can get to a situation where people don't understand the dynamics of the local housing market, they just look at, that's a fairly cheap flat. It's like one I also own in London, and they think it's a good price. But in the context of the local property value and the property market, they're actually buying something that is going to be difficult to sell in the future. And the people might, for example, be buying flats in an area that has a particularly aging population. Well, 10, 15 years time, because the typical buy-to-let is meant to have a rough lifespan in terms of investment, maybe 15 years or so. Then the elderly population is getting older. Are they going to want to buy a flat? No, the answer is they're going to probably want something that's easier to access. So you have to think about the dynamics of a population. So overall, it was an eye-opener for the people who were there, who were lots of landlords. They got a lot of value from it. I'll give you another example. Croydon, which is, if you don't know London, it's in South London. And they were saying that Croydon gets a bit overlooked because, was it an opportunity, one person asked actually, to buy there? Because it's got brilliant transport links. But as she highlighted, 30% of the office space is empty in that area. So the economy isn't as strong as people think. And also it suffers from the fact that people in central London tend to want to then move to a bigger place. Say they own a smaller property in central London that might have gone up in value. They're likely to skip Croydon because of where it's positioned and go for somewhere out in Kent, or go to somewhere like Woking and places like that. So where its position is in the capital in relation to the central part of London, it struggles to attract people. So therefore, if you buy there, it may mean that you won't get the capital growth on your property. And all these things have to be factored in, because if you're thinking it will just go up, then yes, it might go up. But if you factor in inflation, and she gave some great examples where people have lost huge amounts of money buying some of these properties because they hadn't thought all this through. And when you factor in inflation. Now, the other thing I want to quickly finish on is she highlighted the importance of diversifying a buy-to-let portfolio too. And so if you...
How do you diversify a property portfolio?
You buy properties that are different, and you buy properties maybe in different areas. So they've all got their niches. So it may be one that's exposed to a student let or student population. If you then might go to another area that might have a slightly different type of population or dynamics or infrastructure, all these things that you're predicting, it might have greater yield growth, not necessarily property price growth, all these things. And you might buy it in a different place altogether. Another example is you might have a series of flats that you like in high-rise buildings, but you might actually buy properties as well in another area. I mean, like houses, because there was somebody there who highlighted the fact they've now got stuck because of the cladding issue that's come around after Grenfell has meant that lenders are very wary about lending to them, or they find it hard to get people to rent them or sell the property, so they're getting stuck. But the problem is their portfolio is exposed to all that same type of housing that has this potential cladding issue, whereas if they had also in their portfolio maybe a property that was actually a house in a different area, they wouldn't have that cladding issue. So they could potentially be able to keep a property empty for a while without it bankrupting them, because it would just be part of a portfolio. Of course, you've got to have the money to do that. And the other thing is the cladding issue highlighted to me that the property market and buy-to-let investing also suffers from black swan events, things that you just do not realise or don't see coming. So the cladding issue that's come around as a result of Grenfell has caused issues for thousands of property owners, but also buy-to-let landlords. And that they couldn't see that coming. And of course, the problem is that the liquidity you've got with property, you suddenly can get stuck and it could cause you problems. And in worst case scenario, you could obviously ultimately go bankrupt. It's quite a nice comparison to what's going on in equity markets at the moment. The markets might be crashing. Whether you want to sell or not is your decision, but you do have that ability to sell if you wanted to, even if it was crystallizing a loss. Because typically, even in a black swan event, you'd be able to get your money back by selling your investment to somebody else, assuming you're not locked in. So it does happen. So the point is, buy to let, you can make some good money, but it did reinforce my view of it, that it isn't for everybody. Accidental landlords are people who end up being landlords because they try to move out of their house and they weren't able to sell it, etc., and they end up renting that property. It just shows you that if you want to make it a success, then just being an accidental landlord, your chances are reduced. If you buy property in an area you know well, you live in, you've grown up in, you've got a much greater chance of succeeding. But of course, to diversify, or you want to try and buy property that you can afford elsewhere, then you need to do your homework. And if someone as expert as Kate takes up to 2 weeks to do it, it's going to take the rest of us that bit longer, and you've got to go and crunch these numbers. You've got to basically be what they used to call a human geographer. You know, when they look at populations, they look at demographics, all this kind of stuff. Fascinating, but it just, to me, opened my eyes to the opportunities of buy-to-let. But it did reinforce my view that buy-to-let really isn't for everybody.
Good. And what we'll do is we'll put that presentation by Kate into the group. It will be in there on Sunday, and that's in our Facebook community group. And if you want to find that, Damien, it's
facebook.com/groups/money to the masses.
Okay, we're going to finish it on the stock market. You mentioned earlier on, this is a small piece on that.
Yeah, so I don't want to dwell on the fact the market is falling, because people need to put it into context. And the way you're going to do that is if you go back and listen to episode 236 of this very podcast, I did a whole piece on the lessons learned from previous stock market crashes. And in that episode, if you jump forward to 14 minutes and 16 seconds in that podcast, I start to talk about the findings of a piece of research, and it focuses on how frequently you get drawdowns of 10% or more and how long it takes to recover from them. But one of the key takeaways is that in developed markets, you get a correction, a fall of between 10 and 20% at least once every 2.8 years. So they are frequent. They do occur. It's just that people have been complacent and uncomfortable about the fact that we're having one now, but they do occur. And if you think the last big one that we had was in autumn of 2018, so sort of October, December time. And so it's been about, nearly 18 months since that event. So they do occur. And I just want people to give some context. And in that podcast, I don't want to cover the old ground. Listen to that. I talk about how often they happen and how long it takes to recover from them. But the main thing I wanted to do on this section was I was asked about using your ISA allowance now that the coronavirus has hit stock markets. And the question was basically, with fear grip in the market and investors are terrified about putting money to work, what should they do regarding their ISA allowance? Should they transfer money in now? Should they just go ahead and do it? Should it be small amounts? When should they buy the dip? Should you just stay out? It's practical stuff like that. So my response to that journalist is that, firstly, if you are planning to invest regularly, then a stock market crash is actually a positive. Because if you think about it, it's the pound cost averaging idea that as the market falls and you drip in money into the stock market, you're buying shares or units in the fund at a cheaper and cheaper price. And when the market recovers, which it inevitably will do at some point, I just don't know when that will be, days, months, years, you will end up making more money on the way up because you've bought more units or shares at a lower price, and when it recovers, you will therefore make more money. So that's the dripping into markets. So if you're doing that anyway and you plan to do that, then you wouldn't change or stop your contributions, or I certainly wouldn't, because this is a good opportunity to get more bang for your buck, as the phrase goes. But what about if you're a lump sum investor? Now, that doesn't mean you shouldn't use your ISA allowance, because you can use your ISA allowance and not invest in the fund. So you
put it into cash.
You can put it into cash. So you could open a stocks and shares ISA with a platform, for example, before the end of the tax year, and then you could choose to invest your funds, or when to choose to invest your funds over a period of time after that can be in the next tax year. Of course, you could just go and put your money in a cash ISA if you wanted and then decide what you're going to do later. But if you put it in the stocks and shares ISA, yes, you won't get a great return on it. But what you can do is, rather than time the market, you could then start dripping in. And if your platform doesn't let you do that automatically, you can just do it manually once a month or whatever your time frame. Start dripping a portion, an equal amount in over a period of time. So you're doing that pound cost averaging, but you're securing your allowance, because the ISA allowance is a use it or lose it allowance. If you don't use it before the end of the tax year, the whole amount, say you had 20,000 still available to you and you hadn't used your allowance, you will lose that. So you should put the money in if you plan to anyway, and you're a long-term investor, meaning you're going to invest for more than 5 years. Put the money in, and then you can drip in over time, and do that not trying to time the market, but exposing yourself to the benefits of pound cost averaging. But the biggest thing I want to highlight to people, when I did a load of research for 80/20 investor members, and it showed that if you increase your investment time frame, so how long you plan to invest, then the impact of when you bought in, the price you bought at, whether you go in all at once or you go in installments, the impact of those different strategies reduces, because it then becomes more about the time in the market rather than time in the market. So the answer is, if your investments are dipped or if the market is falling, all you need to really do is extend the time frame that you plan to invest for, because it gives you a greater chance for it to recover. So that's obviously assuming you are able to do that. But increase your time frame, then what happens in this week or months going forward starts to become less and less important. It has a smaller and smaller impact on your eventual return when you want to actually take the money out. And finally, just another point, when I did a piece of research, I think I spoke about it on the podcast before, but I looked at 31 years of movements on the daily movements in the FTSE 100 and looked at what would happen if you had a severe market correction, what you should do, or how the market behaves around a severe market correction. And the upshot was that you would normally be better off staying in the market to get the inevitable bounce that comes along rather than making a knee-jerk reaction and pulling out. And as a long-term investor, you don't want to try and time the market. So hopefully that makes people feel a little bit better. It gives them some context when they listen to that past episode. But the other final point I want to make is that this sell-off, the coronavirus, has been a great opportunity for people to take stock of their investments. And if you are at all worried and you haven't been calm about this whole situation, you've been having sleepless nights, then you are taking more investment risk than you are genuinely happy with, you can cope with. You may have thought, I can take this amount of investment risk, I'm a high risk investor, but if you're having sleepless nights, you're checking your portfolio daily, then you aren't. And so you need to review that and look at taking less investment risk because you're not comfortable with it. So it's a good reminder. Don't let that go to waste.
Excellent. So if you want to get in touch with Damien, you can do so, Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with a number 2. And of course, as we mentioned earlier, get onto our Facebook community group. We've also got a YouTube channel and we're on Instagram. Lots of stuff going on Instagram as well. So
I know some of you obviously have children who may be in their 20s, or you may be in your 20s yourself and you listen to this. I just did a video of how to start investing in your 20s that's just gone out on YouTube. So go and have a watch of that or share it with anybody who you think it would be useful to.
Right, we're done.
We are done, Andy.
Until next time.
Until next time.